Have you ever wondered what would have happened if you bought silver many years ago? What if you just held one single ounce of this shiny fine silver? Or what instead if you invested this same amount in the US stock market? Today, I want to conduct a simple 15-year experiment, silver versus SPY, the ETF that tracks the S&P 500, to show you which investment really built more wealth from 2011 to today, February 25th, 2026. Okay, so let's rewind to January 2011. Silver's riding high after the financial crisis. A lot of people were convinced it was going to the moon at this point. On the first trading day of January 2011, silver was about $30.72 for 1 ounce, like you see here. Fast forward to today, February 25th, 2026, and silver trades around $90.75 for the same 1 ounce. So really good returns for that period of time. But let's break that down. First, you spent $30.72 for this 1 ounce of silver. Then today it's worth $90.75. That's a total profit of $60.03, a total return of 195%. That means your money almost tripled. Not bad for a shiny piece of metal that literally just could sit in a desk drawer. But now let's compare this to something simpler. Just owning the US stock market, and in particular, the S&P 500. SPY, is an ETF that tracks the S&P 500. It's basically a basket of the 500 biggest, strongest American companies. So what was SPY worth in 2011? SPY tracks the index of the S&P 500, and on January 1st, 2011, it was around $128.26. Today, SPY is trading around $692.46 as of January 25th, 2026, midday. So here's the math on the S&P 500 investment. Starting price, $128.26. Ending price or current price, $692.46. Profit, $564.20. Total return, 440%. And that's just the price return alone. The S&P 500, and in this case, SPY, also paid out quarterly dividends that entire time period from 2011 until now. And those dividends could have either been received as cash and used or turned around and reinvested. At any rate, either one of those methods that you take with the dividends is going to increase that 440% return by a lot. So to recap, silver returned 195% during that time frame. The S&P 500 through SPY returned 440%, not even counting the dividends. That's more than double the return of silver. Now let's bring this home with this story, right? So imagine you have two friends. You've got your silver friend, and then you've got your S&P 500 friend. They both have $10,000 to invest. So silver friend spends $10,000 on silver at $30.72 an ounce. Today, that would be worth $29,550. Friend number two, your S&P 500 friend, invests $10,000 into SPY, the ETF that tracks the S&P 500, and spends $128.26 a share. And today that's worth over $54,000. And again, we're not even counting the dividend income that's come through for that entire time frame. Our S&P 500 friend nearly quadruples his money versus our silver friend who nearly triples his money. And remember, that's before we even talk about the dividend reinvestment on the S&P 500, which would push that return quite a bit higher. Okay, so now let's really talk and think about why did S&P 500 win over the shiny piece of silver? Okay, so here's the simple explanation for that. Companies grow. This shiny piece of silver stays the same. A piece of metal never invents new products, hires workers, or expands globally. But companies like Apple, Microsoft, Amazon, and Google, they compound money year after year. Okay, secondly, the S&P 500 consistently replaces itself with winners. The losers get kicked out of the S&P 500. The winners stay in it. It's like a sports team that only keeps their MVPs. All right, number 3, dividends quietly supercharge their returns. Many S&P 500 companies pay quarterly dividends in cash. Silver pays nothing. Number 4, innovation drives stocks, not metals. Cloud computing, AI, healthcare advances, EVs, robotics. The last 15 years of growth didn't come from commodities like silver. They came from companies that build the future. All right, so here's the real takeaway. Silver, it did grow. It held value. It acted as a decent inflation hedge. But the S&P 500 through SPY didn't just hold value. It created wealth big time. From 2011 to 2026, silver made a 195% return. The S&P made 440% return in price action alone, not including dividends. That's why long-term investors tend to lean towards stocks over metals. If you want money to grow historically, owning great businesses beats owning shiny objects. If you found this breakdown helpful, please hit the subscribe button, like the video, share it with someone you think it could help.